Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt. And magically, when you throw all of your money into debt, it goes away relatively quickly. And we use the help of something called a line of credit to help us pay off our debt, right? And once your debt is paid off, you're going to be the opposite of most people because what are most people? They're pretty much tired, right? They're tired from everyday life. I mean, it's every time I log into YouTube, I see these TikTok compilations about people freaking out about money, people running out of money, financial crisis on the rise. I mean, take a look at this lady right here, right? I'm fed up with the battles of finance struggles and big decisions. And then the lady over here working to be broke in Ontario. I need help. Can someone advise me? And then this lady right here, I'm so tired. Being a homeowner sucks. I can't afford my house. I'm going to tell you when being a homeowner doesn't suck, when your mortgage is paid off. And I'm just going to brag a little bit right here, just because that's what I do in this channel. I paid off my mortgage in 2 years and 9 months. Okay. So that's literally what I did. And you know, yeah, I'm flexing right now. Totally am flexing. Okay. Let us stare at this for a couple more seconds before we get into the velocity banking review. So, all right. I think we stared at it long enough and we'll just get into it. So, what is velocity banking? It's a debt payoff strategy. And it's kind of like not saving money rebranded, right? So it's like a cool way to not save money because if you take a look at this budget right here, you see how we have a penny of savings? Well, this is going to be a zero, okay? And we'll get back to that. So the first step of velocity banking is listing your income, then your expenses, and then doing an expense breakdown. And the expense breakdown, you have to list every single debt that you have, right? Because this is a debt payoff strategy. And then here we have our non-debt expenses, which is our food, gas, insurance, and all that other good stuff. So what we're going to do is we're going to copy the income and the expenses, right? Same income, same expenses, but here's what we're not going to do. See, if you ask the average person, right, what's better, saving a penny or saving nothing? The average person will be like, well, you should save something, right? But when we have debt, we're not gonna save any money at all, and we're gonna have this number called cash flow that we're gonna try to increase as soon as possible with the help of something called a line of credit, right? And so what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again, right? So line of credit. So if you take a look here, this is my home equity line of credit. $280,000. And you know what? If I take a look at this, this seems like so low to me nowadays, but home equity line of credit. So basically, you just go to the bank's website, click a button, and they'll dump up to $280,000 into your checking account and charge you a 7.5% interest rate, no questions asked, right? And so you can use it to pay anything. Like if I have a $50 bill here, I just click a button to pull out $50 in my checking account, and then I put it back and bill paid, right? It's crazy. Like you can't do that with the credit card, but you can certainly do it with the home equity line of credit. And so I have oodles and oodles and oodles of credit, $594,000 in lines of credit, right? 594,000. So what is the secret to getting all of this credit? I'm going to tell you the secret is that banks don't lend money to people who need it. They don't. And so if you need money, they'll be looking at you like you're a little bit funny, right? Like, "Oh, you need money? Like, what?" And so, when I wake up, I just ask myself, do I need money today? And if the answer is yes, I'm not going to a bank, right? And if I don't need money, that's the best time to get credit. And that's how I got all the lines of credit, home equity, personal, business, personal. And the less money you need, the more you go to the bank and then they'll lend it to you because banks don't lend money to people who need it. All right. So let's assume we have access to a $90,000 home equity line of credit at 8% interest rate. Now, I'm not saying they're going to give it to you. What I'm saying is that if you knew this strategy, you would never be here, okay, with one penny left over because you got all this debt. Now, let's do this. Let's go ahead and figure out which debts to move to our line of credit, and we're going to increase our cash flow bigly, okay? So we have this formula called the cash flow index. If you don't know what it is, basically it's like the balance of the debt divided by the monthly payment, and it gives you an arbitrary number, right? And so this arbitrary number is kind of like a ranking system. The lower the number, the more bang the that's the one you want to pay off first. So it's like you get more bang for your buck for paying off debt. So right here, $5,000. Okay, if I pay off the 5,000, I get 175. If I pay off the 30,000, I get 950. Or instead of paying the 30,000, I could pay the 220 and get 903, right? So if I focus on this one first, I don't get that much bang for my buck. So what I'm going to do is focus on these low ranking ones, get the 30, get the 950 and all the other ones, and we're going to increase our cash flow. And how much credit card debt is this? 5, 30, 31, 22. And then we're going to sum them up, and that's 88,000. So 88,000. And so now, okay, we've done that. And guess what happens just by simply shuffling our debt? Okay, we have this number called cash flow, and this is going to be 0, 0, 0, 0. And we literally went from a penny to $2,902.51 without making more money. So you see this right here, how the income is exactly the same. I know it's funny, right? And then the final step is you put your entire paycheck into that line. So it does two things. It satisfies the minimum monthly payment, and then it lowers the interest because the interest is based on the average daily balance. And then when you got to pay your bills, you take out the 3,000, and then after every single month, your debt is going to go down by 2,900. And we did this by simply not saving money and making our line of credit as our main operating account. You see, the average American, what they do is they pay their bills out of their checking account and then leave the leftover in savings. What we're going to do is we're going to make our line of credit, we're going to move some debt into it, make it as our main operating account, put our entire paycheck into it, and then after every single month, the balance will go down by $2,902.51. Okay. If I scroll up here, this is like your ultimate clickbait moment. Marketing, right? Marketing of velocity banking. How do we get from here to here? See, the average person would be like, oh, we need to make more money, but we don't because this number is the same, right? And then now what we're going to do is we're going to get the next month's balance, which is I2 plus 1, G2 plus H2 minus 2902.51. And then what we're going to do is take the average daily balance, multiply it by the interest rate, which is 0.08, and then divide by 12. And then that's the interest we have to pay. So paycheck in, expenses out, paycheck in, expenses out. So see how it's just going down, 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 down? Yeah, I know, right? All right. So that's what we're going to do. And then do this. And we're good. So in 34 months, I feel like I've done this 100 times already. Got to make this to 101st. So 34 months, we got it all paid off. And then this is going to be 88K. All right. And so now what we're going to do is I don't even know what we're going to do. Oh, we're going to now tackle on our other 3 loans. So what we're going to do is type in the current month in our super duper loan calculator, super sophisticated. And so now we're in the 34th month. And how do we know which debts to pay off? Easy. Use the cash flow index, right? So a lot of people, they'll focus on this right here, 7.5%. But let's focus on this one right here, because for the 11 grand that we pay, we get $459 back. Whereas if we focus on this, we'll get $415 back in our cash flow. So let's go ahead and move this right here. And then I am going to move this into our line of credit. And so that's going to be an additional 11433.02. And then this is going to be 0. And then this is going to be $3,361.80, right? And so I'm just going to do this right here, and then we're going to update our cash flow. And then this is going to be 3361.8. Okay. And then we see in 1, 2, 3, 4, in 4 months, how do we pay off that auto loan? I don't know, right? And then this is going to be, it's 34 plus 20. No, what did I do? Are we in 38 months? Yeah, so this is going to be 38 months. 38 months. and then this is going to be 88 plus 25. And before we continue, I'm just going to tell you a random story that happened to me. So, well, it didn't happen to me exactly, but I was at my local supermarket, my local Publix, and then sometimes I like to surprise people that I speak Spanish because I'm Korean, right? And so when I was at the supermarket the other day, the girl at the counter, she was speaking Spanish to like the customer in front of me. So what I did was I just kind of blurted out like, "Oh, you speak Spanish?" And then, you know how you know when you're good is when they don't speak back to like they don't have the thought that they're gonna speak back to you in English. That's how you know when you're good. And then, so that's what happened like a couple days ago. And then she told me like she came from Colombia like 2 years ago. And then she just kept speaking to me in Spanish. I was like, this is so annoying. I'm just kidding. Actually, I found it to be a compliment. Because I lived in Colombia too. I lived in Colombia too, you know? Because here's the thing, like, when you sound like I don't even know if I sound like a native speaker or not, but I just find it funny when I blurt out my Spanish that they don't have a desire, like, most people don't have a desire to, speak to me back in English. That's how you know when you're good, right? Random story, and I was like, "Do habla español?" Like, you speak Spanish. I like to do it the, uh, just mumble my words just to see if they understand me, and they do. That's how I know I've gotten into gold tier status of my Spanish, okay? Anyways, why am I even talking about this? Okay, let's go ahead. And all right, so now this is 38 months. So this is 0, and then this is 38. 38. All right, 30, or maybe I could do my gringo accent. I love pulling that one out. It makes people laugh. Mi español gringo. Reminds me of Peggy Hill from King of the Hill. Remember that? She was like the substitute Spanish teacher. I love King of the Hill. Anyways, all right. So this is gonna be. Where am I? I don't even know what I'm talking about anymore. All right. So now we're gonna move this student loan. We're at 38 months into the line of credit, and I'm gonna do that right here. All right. Plus 26592.37. All right. So now what we're gonna do is do this, and then our cash flow is $3,777.25. And I'm gonna do that right here, and then this is gonna be 3777.25. All right, and then 45 months, it's paid off, right? 45 months, and then this right here. So wow, all right. So here's the thing, right? I know some of you might think that it's a good idea to move a loan always into a line of credit. It's actually not, right? Got to be a little bit careful. The one place where you can really screw up with velocity banking is that 30-year mortgage. Okay, the 30-year mortgage, because look at this high cash flow index number. What does that mean? You pay off the loan, you get such little cash flow, bang for your buck, that you'll probably overpay when you don't have to, right? So you could still use an 8% line of credit to pay off this 2.8% mortgage, but there's a totally big difference between moving your loan into a line of credit versus chunking it, meaning you move a piece of the loan into a line of credit. And so as I've done this demonstration many, many times where it's way better. Okay, I haven't found a single exception to this. So basically, if there's a huge difference between the loan and the line, and you got this big cash flow index number, meaning that you got a huge term, right, a long term, um, you don't want to move the loan into the line. And I think I did this before, right? I put in all the details, the deets, right? 2.8%. Look at this, $7,000. We only paid 12 grand of interest when paid off in 4 years. But if we move the whole loan, right, the whole balance into the line, look at this. You're paying about 40 grand. That's gross. That's ew. Ew. I don't want to do that, right? I'd rather pay 12 grand, okay? And here's the crazy part. Here's the thing that people don't understand. 30% chunks. You see how that 16 grand will be an 8% um mortgage replacement. Let me do this. See that 39 grand. See? It doesn't make sense, does it? Because it's not intuitive. All right, so there we are. So this is 0, and then I'm gonna go here, and All right, so let me do this student loan. And then this is going to be, what is it? Let me do a $7,000 chunk here. So 4 years and then 4 years. Cuatro años. You want to know something? Okay, I want to tell you something funny about the Spanish language, right? So y'all know, like in Spanish, like, oh, do I have my Spanish keyboard ready? Hold on one second. I think I do. All right. So, okay. So, and then there's two words, right? So they look very similar, but it's amazing how one little accented right character right here can change the meaning, because this one means year. Like they say, hey, how old are you? ¿Cuántos años tienes? Tienes. That's my gringo accent. And then this one is this, right? It's Spanish trivia. Spanish trivia. All right, so let's go ahead and not wipe this out, but this is going to be 7.17 years. We're debt free. We're debt free. Okay. All right. So yeah, that's it. End of end of end of the training, right? And so if you made it to the end of the training, just type in right here, línea de crédito. Línea de crédito. What does that mean? Line of credit in Spanish. I don't know why I'm in a Spanish mood today. Let's see if I put that right. Right? Let me put the accent. Línea de crédito. Línea de crédito. Line of credit. So, if you made it to the end of the video, let me know by typing in línea de crédito in the comment section. Okay. All right. All right. Well, have a great day, everybody. This is Korean Lanta Mentorship, and then I'll see you in the next one.